I have been getting asked a lot about my opinions on the Magnificent Seven stocks and if they're offering value at today's prices. For those of you who may not know, the Magnificent Seven are Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. So in today's video, I want to quickly share my thoughts on the Magnificent Seven, their prices today, and discuss if any of them are looking cheap. Before we get into the video though, I just want to let you all know that we just made Stock Unlock much more free to use. You can now use the platform with a free account and analyze stocks. There are limits on the free account, but you will still get a lot of features and a much better tool than Yahoo Finance, again for completely free. So make sure to go and check out the new free version of Stock Unlock. Now with that being said, let's just hop right into the video. And we're going to start off with Microsoft. Microsoft stock is selling right near an all-time high right now, and we're going to quickly discuss the company's financials and what the market is pricing in. So if we head over to Microsoft's income statement, we can see that its revenue is at an all-time high, and it does look like the revenue growth has been accelerating, especially over the past about 4 quarters now. If we also take a look at Microsoft's operating cash flow, we can see that it is accelerating and growing and hitting all-time highs right now. So this is really great to see because the business's fundamentals have never been better. However, if we go and take a look at Microsoft's price to free cash flow over the past decade, we can see that it has been consistently increasing over that time. And now Microsoft is selling for a price to free cash flow of 46.4, which I do think is on the very high end. In fact, if we take a look at the compounded annual growth rate of the price to free cash flow over the past decade, it has been expanding by about 13% annually. So 13% of Microsoft's annual growth to its share price has come from multiple expansion. And if we actually take a look at Microsoft's free cash flow growth over this time, it's only been about 12%, which does still mean that the business's fundamentals have been growing very well over the past decade, but the price to free cash flow expansion has actually created more stock price growth than Microsoft's overall fundamentals growing. And that overall does lead to the stock becoming quite expensive, again with that price to free cash flow of 46 now. Another way to put this in perspective is if we take a look at how much cash Microsoft's business could distribute back to its shareholders at its current price, it's about 2%. So that is the amount of cash the business could actually return to you, which is lower than a bond yield, and honestly a 2% annual return to shareholders is not very good. So to me, I do think that Microsoft is looking quite expensive right now. Now, if we head over to Stock Unlock's discounted cash flow calculator and do a reverse DCF on Microsoft to see what the market is currently pricing in, it shows just how expensive the stock actually is today. Now, what I put into the DCF here is a 26 price to free cash flow, which is Microsoft's average over the past 10 years. And we can see that if Microsoft does trade for a 26 price to free cash flow, then it needs to produce 22.5% annual free cash flow growth over the next 5 years to be at fair value today and produce a 10% compounded annual growth rate. So this is what the market is currently pricing in to Microsoft's stock. And even if we bump this price ratio up to 30, which I do still think is quite expensive, then it does mean that Microsoft needs to grow its free cash flow at 19.1% annually just to justify the stock price today. So I do believe that Microsoft stock is already factoring in a lot of future growth. And to be clear, I do think that Microsoft's business and its fundamentals are going to continue growing over the next 5 years, over the next decade and everything. I simply think that today's stock price is already factoring in a lot of that future growth, which does make the overall stock quite expensive. All right, but now let's move on to the next stock in the Magnificent Seven, which is Apple. Apple is down about 13% from its all-time highs, so let's take a look at how the stock is currently being valued. And first, I want to go and take a look at the income statement and take a look at the revenue here. And here we can see that Apple's revenue has not grown since the first quarter of 2022. So there has been about 2 years now where Apple's revenue hasn't grown, and the overall business does not look like it is really growing right now. However, to be fair, Apple has gone through periods like this historically. For example, from 2015 to about 2020, Apple's revenue didn't really grow all that much. So the company does seem to have a history of having flat revenue growth for a few years, and then they release some sort of new product, and then that starts to boost the company's overall revenue and profits once again. So Apple really does look like it needs to launch another product that is going to start generating the company billions of dollars in revenue. Now, if we take a look at the operating cash flow, we can see that it also has been topping out for about 2 years now and is not really hitting new highs. Now here we can also see that Apple is selling for a price to free cash flow of about 24.5 right now, which is on the higher end, especially for a business that is not growing its revenues or its profits. Now what's also interesting to note is that when Apple was in its last period of little revenue growth between 2015 and 2020, the stock was trading for a price to free cash flow of anywhere from 12 to about 16. So these are the prices that the market was willing to pay the last time Apple's business saw a slowdown to its overall revenue and profit growth. So in my opinion, again, I do think that this is a high price ratio for a business that is not really growing. Now, if we do a reverse DCF on Apple stock to see what the market is currently pricing in, we can see that the market is pricing in about a 20 price to free cash flow, which is much more in line with how this business has traded historically, about 3.7% annual buybacks, which is what the business has done historically, and about a 10.8% growth rate to the overall free cash flow. So the market is basically pricing in around 11% annual free cash flow growth to Apple's business today. Now, again, the business is currently in a little bit of a lull, and personally, I do not have the conviction in Apple to know what is the next product that they're going to release that's going to boost profits and revenue. And right now, I don't have that conviction that Apple is actually going to achieve this level of growth annually over the next 5 years. So to me, I do believe that Apple's stock is looking quite expensive today. And I do not think that this stock is a buy for me personally. All right, moving on to the next stock, which is Amazon. Amazon stock is actually right back to near all-time highs at about $180 per share. So let's take a quick look at its income statement as well and take a look at the revenue. So here we can see that Amazon's revenue is also hitting all-time highs and the business's growth is just very, very consistent. Now, if we also go and take a look at Amazon's operating cash flow, which is my favorite metric for this business, and it is the metric that the market has followed most closely historically, and I have talked about this previously on my channel before, we can see that Amazon's operating cash flow is exploding and hitting an all-time high now of about $85 billion in the trailing 12 months. And I do believe that this is going to continue consistently growing over the long term now, as Amazon is focused on continuing to grow its profits. Now, what's also interesting is if we go and take a look at Amazon's price to operating cash flow, it is only sitting at 21.8 today, which is well below the company's historical average of about 27.7. Now, what's also interesting is if we zoom all the way out to 2008, we can see that every time Amazon stock hits a price to operating cash flow of about 20, the market comes in and buys up the stock. So it looks like the floor for Amazon stock historically has been around a 20 price to operating cash flow. And that is right around where Amazon stock is selling today. So in my opinion, taking a look at Amazon's price to operating cash flow of 21 today and the historical averages, the stock actually does not look very expensive to me, and it's arguably selling below fair value. Now, if we do a quick reverse discounted cash flow calculation on Amazon, we can see that the market is pricing in about a price to operating cash flow of 25 over the next 5 years, which still is below the company's historical average of, again, 27.7. Now, with a 25 price to operating cash flow, Amazon only needs to grow its operating cash flows by about 8.5% annually over the next 5 years, which personally I do believe that Amazon can achieve, and I do actually think that this is quite bearish for the overall business. And I would not be surprised to see at least 10% annual growth to Amazon's operating cash flow on an annual basis over the next 5 years. So this kind of increases my conviction in the thought that Amazon could be selling below fair value right now, or at least near fair value. So in my opinion, Amazon is not looking very expensive today in the market at all. All right, but now let's move on to the next one, which is Google. Google stock is also back to near all-time highs, sitting at $151 a share. Now, if we quickly take a look at its income statement, we can see that its revenue is also sitting at an all-time high, and the revenue does look like it has been accelerating over the past about 4 quarters now. And Google is actually seeing some pretty good growth to its overall revenue. Now, if we take a look at its operating cash flows, it is now sitting at $102 billion in the trailing 12 months, and it does seem like the operating cash flow is kind of starting to make its way up. However, what is interesting is Google's free cash flow is not really sitting as close to an all-time high as the operating cash flow. And this is because Google has had a lot of capital expenditures over the past year, and they are projecting to have a lot more capital expenditures in 2024. So I do think that the free cash flow growth for Google is going to be a little bit dampened over the next year. Now, if we take a look at Google's price to free cash flow, it is currently sitting at 27, which is slightly below its 10-year average of about 28.7. So it is slightly below its historical average price ratio, which could mean that it is selling near fair value today. I do not think that this stock is overly cheap, but I don't think that it is overly expensive either. So my gut is telling me that the stock is probably near fair value. Now, right here, when Google was selling for a price to free cash flow of 18 in November of 2022, that is when the stock was very, very cheap. And I made a video on my channel during that time saying that I was loading up my Google position, and I'm very happy I did. But at today's prices, again, with the stock being around fair value, in my opinion, it's not really one that I am looking to add more to in my own portfolios. So let's quickly do a reverse DCF on Google right here. And I'm saying that the market is going to value the company at a price to free cash flow of about 25. They're going to buy back about 2% of their shares annually. And if the business does this, then it needs to do about 9.5% annual free cash flow growth to be considered fair value today. 9.5% annual free cash flow growth is something that I do believe Google can achieve on an annual basis over the next 5 years. So again, this is kind of why I'm saying that I believe Google is selling for about fair value today. I don't think that it's going to compound free cash flow like 15 or even 12% over the next 5 years. So 9.5% to 10% is kind of what I am expecting as an investor in this business. So again, I do think that the stock is kind of just near fair value today. All right, let's move on to Meta, which is now $493 a share and selling right near all-time highs. This stock has one of the craziest charts that I have ever seen. I mean, back here in November of 2022, this was an $88 stock, and it is now up almost 500% in less than 2 years. And this is a mega cap company, over $1 trillion. That is just insane to me. So let's take a quick look at Meta's financials here. And if we take a look at the revenue, we can see that it is hitting all-time highs, and the revenue has been growing very nicely, especially over the past about year now. If we also take a look at the cash flows here, we can see that operating cash flow is exploding and hitting an all-time high of $71 billion now. Mark Zuckerberg really turned around this business, and the year of efficiency that Meta had in 2023, profits are back to an all-time high, revenue is back to an all-time high, and the business really just turned itself around. So hats off to Mark Zuckerberg. He did an incredible job there. Now, if we go and take a look at Meta's price to free cash flow, it is sitting at about 29 right now. The average over the past decade has been about 30.2. So the price to free cash flow today is slightly below its historical averages, but I do still think that this is on the more expensive end. Meta in 2022 got to a price to free cash flow of 9, and this is when it was very, very cheap, okay? But now the price ratio has multiplied by 3, and again, it's all the way up to 29 now. So again, I do not think that Meta is a very cheap stock right now, and it is not a stock that I am looking to add to my portfolio at its current prices. I was a buyer of Meta when its price ratios were all the way down here, and I was consistently adding to my position, and I have since exited that position because I have always said that Meta is not a business that I have very high conviction on. It's not a stock that I really can know for sure if it's going to be growing in like 15 years from now. So it was just a stock that personally I did not have a lot of conviction on, and that is why I sold it into this run-up. Now, I do believe that the stock is on the more expensive end, and I would want to see it correct significantly for me to want to build a position in this business once again. I simply have more conviction on Amazon and Google right now, and these businesses are trading for lower price ratios today. So those are two stocks that I would be much more compelled to increase my position in over adding Meta today. Now, if we do a reverse DCF on Meta here very quickly, we can see that I'm going to put in a price ratio of about 26. And at this 26 price ratio, Meta would have to compound its free cash flow at 10.5% annually from what it did in the trailing 12 months. Now, again, I do not have the conviction on Meta to know for certain if it is going to be able to compound cash flows at 10.5% annually. So from here, again, this is just a stock that I would not really be looking to add to my own portfolio. However, I will say that Meta looks significantly cheaper than Microsoft and Apple. It's probably selling slightly above fair value, if I had to guess. All right, but now let's move on to the next stock, which is Tesla. Now, Tesla is actually in quite a significant correction from its all-time highs right here. It was a $400 stock, so it's down about 57% from its all-time highs. And Tesla is actually a stock that I have been asked about quite a bit recently due to its recent corrections and being down 50% from all-time highs. So let's take a quick look at its financials and see what's really going on with this business right now. So if we take a look at Tesla's revenue, we can see that it is actually topping out, and the revenue growth for this business has slowed down significantly. Now, it is worth noting that from about 2018 to about 2020, Tesla's revenue growth was slow back then as well. So maybe the company is going through a period of slow revenue growth right now, and maybe they need to produce some sort of new car or whatever. All I know is Tesla's revenue growth is definitely slowing down, which I would not love to see. Now, if we take a look at Tesla's operating cash flow, we can also see that it is in a dip right now, and it's currently downtrending. So while the revenue is hitting new highs, the operating cash flow or the profits that the business generates is going down. Now, personally, seeing the stock price down while overall profits are declining makes complete sense because stocks follow the profits that the business produces over the long term. Stocks do not follow revenue growth over the long term. So despite Tesla's revenue being at all-time highs, if its profits are going down, then the stock should follow the profits down. The operating cash flow declining despite revenue being at all-time highs also tells me that Tesla's profit margins are declining and probably quite significantly. All right, now if we take a look at Tesla's price to operating cash flow, it is sitting right around 44, which is so far the most expensive business that we have taken a look at so far in this video. Now, this is also a very high price ratio for a business where its profits are currently declining and its revenue growth is slowing down significantly. So right away, I do think that Tesla is a very expensive business still, and I do not think that the stock is offering any real value at all. The stock would have to continue falling quite significantly before I saw any value in it. This is still a very, very high price ratio for a business, again, where the profits are going down and the revenue growth is slowing down significantly. All right, now if we do a quick reverse DCF on Tesla stock and say that the stock is going to trade for a price to operating cash flow of 35, which I do still think is very expensive for this business, it means that Tesla would need 14.8% annual growth to its operating cash flow over the next 5 years. Now, personally, with the revenue growth slowing down and with the profits currently declining, I think that this is kind of a stretch for Tesla's business to hit. This is also not a stock that I have very high conviction on. I know that this is kind of like a cult stock, or that there are people that have a lot higher conviction or a lot more knowledge on Tesla's business than I do. But I'm just being honest, I don't really see this business growing its profits at 15% annually over the next 5 years, and it would still have to trade at a 35 price ratio while achieving those significant growth rates. And again, this is just for the stock to be considered fair value today. So if anything less than this happens, then it does look like investors will see inadequate returns or potentially even lose money. So Tesla is still pricing in a lot of future growth at its current price, and it's just not a stock that I think is looking cheap today at all. All right, moving on to the last stock in the Magnificent Seven. This one is Nvidia, and this stock has just been insane, okay? I mean, just look at that stock chart. So let's take a quick look at Nvidia's financials because they're also pretty freaking insane. Nvidia's revenue is sitting at an all-time high, and the revenue growth has just been ridiculous. The revenue is just exploding. Now, if we go and take a look at the cash flow, this is the exact same story. Operating cash flow is just exploding, and it's now sitting at $28 billion of operating cash flow in the trailing 12 months. So let's take a look at the price of this business now. So today, Nvidia is selling for a price to operating cash flow of 80, which is very, very high in my opinion, which basically just means that this business is pricing in a lot of future growth today. In fact, if we go over to our discounted cash flow calculator and add in Nvidia, we can see what the market is pricing into Nvidia's shares today. So in this DCF, we are going to say that Nvidia is going to trade for a price to operating cash flow of 50, and at a 50 price to operating cash flow, it would need to grow its cash flows by 21% annually over the next 5 years just to be considered fair value today. That is what the stock is currently pricing in. This is still a very high price ratio, and 21% annual growth to profits is very high. In fact, if we scroll down right here, this would mean that Nvidia would have to produce $73 billion worth of operating cash flow by the year 2029. That is a lot of growth to operating profits and still a very high price ratio. Like if we drop this price ratio down to 40, then it means that Nvidia would have to grow its operating cash flows by about 26.5% annually, again, just to justify the price today. And if we scroll down, this would be $91 billion in operating cash flow for Nvidia by the year 2029. That is just insane growth, okay? And I cannot stress this enough. This is what the market is pricing in today to Nvidia's stock, is all of this growth. So when you're buying Nvidia stock today, you're already paying for 26% annual growth at a 40 price ratio. So if the multiple contracts back down to like 30 and Nvidia produces maybe 20% operating cash flow growth, which is still very, very strong operating cash flow growth over the next 5 years, then the fair value is about $520, or about 42% below where the stock is currently trading. And investors will lose money on their investment over the next 5 years. And these are still pretty dang optimistic numbers right here. So I don't know for sure if Nvidia is going to continue growing like it is over the next 5 years, but I do think that the stock is very, very expensive and kind of dangerous. In fact, in my own life, I have had a lot of people who never invest or have never showed any interest in investing, specifically asking me about Nvidia's stock, if I'm buying it and if I think they should buy it too. Now, obviously, I'm not a financial advisor, so I never tell anyone what to do with their money, but I find that it is very interesting that, again, people who have never invested before or showed any real interest in investing are specifically asking me about Nvidia's stock and if they should be buying it. I actually had one person tell me that everyone at their work is buying Nvidia's stock. Why? Because the stock continues to go up. That is kind of bubbly to me. That shows that a lot of people, a lot of regular people are looking at Nvidia stock specifically and are wanting to buy it just because the stock price has been going up. And that is probably why the stock is so freaking expensive today. I do, again, think that it is looking a little bit bubbly, and it's definitely not a stock that I think offers a good risk reward at its current price. Now, that's just me. I've missed out on this entirely big run that Nvidia has had, but I'm completely okay with it. This is not within my own investing strategy or in my own investing wheelhouse. So I am completely happy to miss out on Nvidia and this whole big AI wave that is going on in the market right now. So in conclusion, I do think that Amazon is looking like the cheapest stock out of the Magnificent Seven because its price to operating cash flow is well below historical averages and right near the lowest that it actually likes to get, at least over the past 20 years. Google, I also think, is selling right near fair value, but I don't think that it is very cheap today, and I also don't think that it is overly expensive. So it's not really one that I am looking to add to my portfolio because, again, I do think that it is probably around fair value. Meta, I do think, is more expensive than Google. It's probably selling slightly above fair value, so it's not a stock that I am looking to add either, and I also don't have as high of conviction on it. So personally, I would much rather add Google or Amazon to my portfolio, especially at current prices versus Meta. Now, Tesla, Nvidia, Microsoft, and Apple all look very expensive to me for varying different reasons, but overall, those stocks do look quite expensive to me, so those are not ones that are on my radar right now, and I am not going to be buying those ones anytime soon. I would want to see some pretty significant corrections to every single one of those 4 stocks before I would consider them at all. So that is my opinion on the Magnificent 7 stocks right now. And if you did enjoy this video or you found it helpful in some way, then please remember to leave a like on it because it does really help out the channel and I do really appreciate it. Now also, if this is your first time here, then please consider subscribing to my channel because that would also be pretty awesome. But with that being said, thank you all so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.